Roughly 60% of American homeowners are currently sitting on a mortgage rate below 4%. Let that number settle for a moment. 6 out of every 10 homeowners in the United States locked in their debt during one of the cheapest borrowing windows in modern financial history. And right now, with rates sitting more than double that level, those same homeowners are facing a decision that has no good answer. Sell and immediately take on a mortgage that costs nearly twice as much per month for the same size home. Or stay exactly where they are, frozen in place, unable to move up, unable to move down, unable to move at all. This is the lock-in trap. And it is not a theory. It is not a prediction. It is the single most powerful structural force operating inside the U.S. housing market right now. It is the reason inventory is historically low despite prices that should be driving sellers to the market in large numbers. It is the reason first-time buyers are being systematically shut out of ownership. And it is the reason the market looks stable on the surface while something far more complex and far more fragile is building underneath. Here is what most people completely overlook. The lock-in trap is not just a problem for buyers who cannot find affordable homes. It is a problem for the entire economic architecture that depends on housing market liquidity. When people cannot move, they cannot take new jobs in new cities. They cannot downsize when their income drops. They cannot upsize when their family grows. The housing market has essentially seized up. And a seized market, as history has shown us more than once, does not stay frozen forever. I want you to hold on to something as we move through this breakdown. There is a specific pressure point building inside this frozen market that most analysts are not talking about openly. When it releases, and it will release, the consequences will not be evenly distributed across homeowners, renters, and investors. Some will be protected, others will not. I will show you exactly where that pressure is concentrating and what it means for your position in the market. But first you need to understand how we got here, because the lock-in trap did not appear overnight. Cast your mind back to the previous cycle. Between 2020 and 2022, the Federal Reserve held interest rates at effectively zero in response to an unprecedented economic disruption. Mortgage rates fell to levels that had not been seen in the entire recorded history of American home lending. 30-year fixed rates briefly touched 2.65%. For context, the historical average over the past 50 years sits closer to 7.5%. What happened in that window was not a normal market. It was a once-in-a-generation financing anomaly. And millions of American households locked in that anomaly as a permanent feature of their personal balance sheet. Stop and consider what that means structurally. A homeowner who purchased in 2021 at a 3% rate on a $400,000 mortgage is paying roughly $1,600 per month in principal and interest. That same homeowner, if they sold today and repurchased an equivalent property at current rates, would be looking at a payment closer to $2,800 per month. That is $1,200 per month in additional carrying cost. $14,400 per year. For the exact same asset class. The financial penalty for moving is not marginal. It is enormous. And it is being silently absorbed by millions of households who are making the rational economic decision to stay put regardless of whether staying put actually serves their life circumstances. Here is something most people completely overlook. This is not just a personal financial calculation. It is a collective market behavior that is reshaping supply dynamics in a way that no policy tool currently being discussed in Washington is designed to address. You cannot build your way out of a lock-in effect. You cannot incentivize your way out of it. The only thing that resolves it is either rates falling back toward 3%, which almost no credible economist is projecting in the near term, or enough life events forcing enough homeowners to sell despite the financial penalty that inventory gradually normalizes. And that second scenario, the life event scenario, is exactly where the pressure point I mentioned earlier begins to take shape. Divorce, job loss, death in the family, relocation for medical care. These are the events that override financial calculations. They force transactions regardless of rate environments. And in a market this frozen, when forced sellers do appear, the dynamics around those transactions are unlike anything the market has seen in a decade. I will walk you through exactly what those dynamics look like and what they mean for pricing, liquidity, and equity protection in the current cycle. But before we get there, you need to understand the second layer of this trap. Because the lock-in effect on existing homeowners is only half the story. What it is doing to the buyer side of the market is equally consequential and in some ways more alarming. The buyers who cannot get in, what they are doing instead, and why their behavior is creating a secondary pressure system that most market observers are completely missing. That is where we are going next. The buyers are not disappearing. That is the detail that changes everything about how you should be reading this market right now. When inventory dries up and prices stay elevated, the instinct is to assume demand has collapsed alongside supply. But that is not what the data shows. Demand has not collapsed. It has transformed. And the form it has taken is creating a pressure system underneath the U.S. housing market that is almost entirely invisible in the headline numbers. Here is what is actually happening to the buyers who cannot break into ownership in the current cycle. They are waiting, accumulating capital, sitting in rental units, in parents' homes, in shared living arrangements, building down payment reserves that are growing larger with every month that passes. The National Association of Realtors estimates that there are currently somewhere between 4 and 5 million households in the United States that are financially qualified to purchase a home, but are actively choosing not to transact at current price and rate levels. 4 to 5 million households. Sitting on the sideline. Watching. Waiting for a signal. Stop and think about what that means for what happens when the lock-in trap eventually releases. This is not a market with absent demand. This is a market with compressed demand. And compressed demand, when it releases into a suddenly available supply, does not produce a gradual normalization. It produces a surge. The history of the U.S. housing market shows this pattern clearly. After every prolonged period of suppressed transaction volume, the eventual reopening of the market has been characterized not by slow recovery but by sharp, sudden repricing as years of accumulated buyer intent floods into newly available inventory simultaneously. Here is something most people completely overlook. The renters who are waiting are not passive. They are making active financial decisions that are reshaping adjacent markets in real time. And one of those decisions is having consequences that will directly affect home values in ways that almost nobody is currently pricing in. I want to plant something in your mind right now that I will return to shortly. The behavior of locked-out buyers is not just affecting the housing market. It is affecting the financial health of the landlords who are housing them. And the pressure building on that landlord class, quietly, below the surface of the market, is one of the most significant and underreported risk factors in American real estate right now. But first, let us stay with the buyers for a moment longer because there is a segment of this waiting population that deserves specific attention. The millennial cohort, currently the largest home buying demographic in American history by sheer population size, is sitting at the precise intersection of peak earning years and peak frustration with housing market access. This generation watched home prices accelerate faster than wage growth for the better part of a decade. They entered the workforce during the aftermath of the previous crash when ownership was cheap but credit was frozen. They missed the 2020 to 2022 window either because they were not financially ready or because they were outbid by investors and relocating remote workers with larger capital reserves. And now they are watching rates make ownership mathematically punishing even for households with solid incomes and genuine savings. You might think this cohort is simply delaying ownership indefinitely. But the reality is considerably more nuanced and considerably more consequential for the market. Research consistently shows that the desire for homeownership among this demographic has not diminished. It has intensified with delay. The longer ownership is deferred, the more financial and emotional weight gets attached to the eventual transaction. These are not buyers who will enter the market cautiously when conditions improve. These are buyers who will enter aggressively, competitively, and with years of accumulated capital behind them. The pent-up demand is not evaporating. It is pressurizing. Here is where the landlord pressure point I mentioned earlier becomes critical to understand. The rental market has been the release valve for all of this compressed buyer demand. Millions of would-be owners becoming long-term renters has kept rental occupancy rates elevated and given landlords significant pricing power through most of the current cycle. But that dynamic is beginning to shift in ways that have serious implications for rental property ROI across multiple U.S. markets. Stop here because this is the detail most investors are missing entirely. Rental supply is now catching up with demand in a meaningful number of markets simultaneously. The construction boom of 2021 through 2023, concentrated heavily in Sun Belt metros, is delivering completed units into a rental market that is simultaneously seeing affordability resistance from tenants who have been stretched to their financial limits. The result is vacancy rate increases, rent growth deceleration, and in some markets outright rent declines of 8 to 15% year over year. For landlords who acquired properties during the peak of the cycle using adjustable rate or short-term fixed financing, this combination of rising vacancies and resetting debt costs is not a future risk. It is a current reality. And the decisions those landlords are being forced to make right now are about to introduce a new category of supply into a market that has been starved of inventory for years. This is what I was talking about earlier when I said the behavior of locked-out buyers is creating pressure on the landlord class. The renters who cannot afford to buy are also increasingly unable to absorb further rent increases. The landlords who need rent increases to service their debt are caught between an immovable tenant affordability ceiling and a rising cost floor. Something has to give. And when it does, the inventory picture in the U.S. housing market changes faster than most current projections suggest. What that released inventory looks like, where it will appear first, and what it means for buyers, sellers, and investors trying to protect their equity position in the current cycle is exactly where we are headed next. The inventory is coming. The question is not whether it arrives. The question is what condition it arrives in, which markets it hits first, and whether the buyers waiting on the sideline are positioned to act when the window opens. Because here is the reality that most market commentary is glossing over right now. Not all inventory is created equal. The supply that is about to enter the U.S. housing market in the current cycle is not the clean, well-maintained, move-in-ready inventory that characterized the pre-pandemic sellers market. It is distressed inventory, reluctant inventory. Inventory coming from landlords under financial pressure, from homeowners facing life events that override the lock-in calculation, and from investors who bought at peak valuations using debt structures that the current rate environment has made untenable. And distressed inventory, as anyone who studied the previous crash cycle knows, does not enter the market quietly. Here is something most people completely overlook. The way distressed supply enters a market matters as much as the volume of supply itself. When motivated sellers begin appearing in a market that has been supply-starved, the psychological effect on buyer behavior is disproportionate to the actual number of transactions. Buyers who have been waiting, frustrated, outbid, and financially stretched suddenly sense a shift in leverage. They begin waiting longer before making offers. They begin submitting below asking. They begin requesting concessions that would have been laughed out of the room 18 months ago. And that behavioral shift, multiplied across thousands of transactions simultaneously, is what turns a gradual supply increase into a perceptible price correction. Stop and consider where you have seen this pattern before. The 2006 to 2008 period did not begin with a sudden collapse. It began with exactly this sequence. A frozen market. Accumulated seller pressure. The first wave of reluctant inventory hitting the market. Buyer psychology shifting from fear of missing out to fear of overpaying. And then the feedback loop accelerating faster than almost any mainstream forecast had projected. I am not suggesting the current cycle ends the same way. The structural differences between now and the previous crash are real and meaningful. In 2006, the problem was fraudulent credit creation producing unqualified buyers who defaulted en masse. The current cycle does not have that specific vulnerability. Most homeowners sitting on low-rate mortgages are financially qualified and have genuine equity cushions built by years of appreciation. But here is the critical distinction that most analysts are drawing incorrectly. The absence of a 2008-style collapse does not mean the absence of a significant correction. These are not the only two options available to the market. There is a third path that the current cycle is far more likely to follow based on the structural evidence. And that path is considerably more damaging to specific segments of the market than the headline stability numbers currently suggest. Here is what I was building toward earlier when I described the pressure building on the landlord class and the compressed buyer demand sitting on the sideline. The most likely near-term scenario for the U.S. housing market is not a crash and not a continued boom. It is a bifurcation. A splitting of the market into two distinct tracks operating simultaneously and producing completely opposite outcomes depending on asset quality, location, and the financial profile of the owner. On one track you have well-located, well-maintained owner-occupied properties in supply-constrained markets with strong employment bases. These assets are going to hold value and in some cases continue appreciating modestly because the locked-in owners of these properties have no financial incentive to sell and the demand waiting to absorb them remains intense. The lock-in trap actually protects these assets by keeping them off the market. On the other track, you have investor-owned properties, particularly small to mid-sized rental portfolios in markets that saw aggressive construction activity between 2021 and 2023, financed with debt that is now resetting into a higher rate environment. These assets are under genuine and growing financial pressure. Their owners do not have the same lock-in protection that owner-occupants have because their decision to hold or sell is driven by cash flow math rather than personal circumstance. And the cash flow math in a growing number of these markets no longer works. You might think this bifurcation only affects real estate investors. But the reality is that it has direct consequences for every homeowner and prospective buyer in markets where investor-owned properties represent a significant share of total housing stock. Stop here because this is where the equity protection question becomes urgent. When distressed investor properties begin hitting the market in volume, they create comparable sales data that affects the appraised value of every property in the surrounding area. A homeowner who has no intention of selling and no financial pressure to do so can still see their paper equity eroded by the distressed transactions happening on their street. And in markets where investor concentration is high, that erosion can be material. This is what I was pointing toward at the very start of this breakdown when I said the consequences of the lock-in trap releasing will not be evenly distributed. The homeowner sitting on a 3% mortgage in a supply-constrained market with low investor concentration is in a fundamentally different position than the homeowner in a market where 20 or 30% of the housing stock is institutionally owned and currently cash flow negative. Knowing which category your market falls into is not a passive exercise. It is an active and urgent one. Because the window between now and when this bifurcation becomes visible in mainstream data is closing. I will show you exactly how to identify which track your market is on, what the specific indicators are that signal distressed inventory is approaching, and what the investors who navigated the previous correction cycle successfully did differently from those who did not. That framework, and the specific asset protection moves that apply to the current cycle, is what we are closing with in the final section. Let us talk about what actually separates the homeowners and investors who come out of a market dislocation with their equity intact from those who spend years recovering losses they never saw coming. It is not timing. Nobody times these cycles perfectly. Not professional investors. Not institutional capital. Not the analysts who write the reports that everyone else reads 6 weeks after the relevant window has already closed. The people who consistently protect their financial position through housing market dislocations are not smarter about timing. They are smarter about positioning. And positioning is something you can act on right now regardless of where you think the market is heading. Here is the framework. And pay attention to this because it applies whether you are an owner-occupant sitting on equity, a landlord managing a rental portfolio, or a prospective buyer waiting for the right entry point. The first element of the framework is what sophisticated investors call the liquidity audit. Most homeowners never do this, and it is the single most consequential oversight in personal real estate management. A liquidity audit is simply an honest assessment of how long you could sustain your current housing costs if your income were disrupted. Not an optimistic assessment. A realistic one. In the current cycle, this matters more than it has in over a decade because the lock-in trap creates a dangerous illusion of stability. Stop and consider this carefully. A homeowner with a low-rate mortgage, strong paper equity, and no immediate financial pressure can feel completely secure while sitting in a position that is actually quite fragile. If that homeowner's income is concentrated in a sector facing disruption, if their liquid reserves are thin relative to their monthly carrying costs, if their equity is entirely paper-based with no accessible line of credit against it, they are one significant life event away from becoming a forced seller. And forced sellers in a bifurcating market are exactly the distressed inventory we discussed earlier. The ones whose transactions damage surrounding property values. The liquidity audit forces you to confront that fragility before it confronts you. How many months of mortgage payments, insurance, taxes, and maintenance exist in your accessible liquid reserves right now? If that number is below 6 months, you are carrying more risk than the surface stability of your position suggests. Here is something most people completely overlook. The homeowners who lost the most in the previous crash cycle were not primarily the ones with bad mortgages. Many of them were financially stretched but fundamentally solvent homeowners who encountered an income disruption at exactly the wrong moment in the cycle and were forced to sell into a falling market because they had no liquidity buffer to ride it out. The lock-in trap creates a specific version of this vulnerability in the current cycle. Because the financial penalty for selling is so large, homeowners who should be building liquidity reserves are instead staying in properties that consume a disproportionate share of their monthly income. They are house rich and cash poor in a market where being cash poor is becoming increasingly dangerous. The second element of the framework is market category assessment. This is what I was building toward in the previous section when I described the bifurcation developing between supply-constrained owner-occupied markets and investor-heavy markets facing distressed inventory pressure. You need to know with specificity which category your market falls into. Not your general impression of it. Not what the local real estate agent tells you. The actual data. And there are 3 specific indicators that tell you which track your market is on right now. The first indicator is investor ownership concentration. In markets where more than 15% of single-family housing stock is owned by non-occupant investors, the distressed inventory risk is materially elevated. These markets have a higher proportion of properties whose hold or sell decision is driven by cash flow math rather than personal circumstance. When that math turns negative, the selling pressure is not gradual. It is clustered. The second indicator is new construction delivery relative to population growth. Markets where permitted unit completions over the past 2 years have outpaced household formation are carrying excess supply risk regardless of what current vacancy rates suggest. The supply is in the pipeline. It is arriving. And it will compete directly with existing inventory for a renter and buyer pool that has not grown fast enough to absorb it. The third indicator is the rate reset exposure of local landlord debt. This requires more research, but it is the most forward-looking of the 3 signals. Markets where a significant share of investment property transactions between 2020 and 2022 were financed with 5- or 7-year adjustable rate mortgages are approaching a wave of rate resets that will force cash flow recalculations across thousands of properties simultaneously. When those resets hit, the landlords who cannot absorb the payment increase become sellers. All at once. In the same market. You might think monitoring these 3 indicators requires institutional resources. But the reality is that all 3 are accessible through public data sources, county assessor records, Census Bureau building permit data, and HMDA mortgage disclosure filings. The information exists. Most homeowners and small investors simply never look for it because nothing in the current headline stability of the market is prompting them to. This is what I was pointing toward at the very beginning of this breakdown when I said the consequences of the lock-in trap releasing will not be evenly distributed. The distribution of consequences maps almost exactly onto these 3 indicators. High investor concentration plus excess supply delivery plus imminent rate resets equals a market where the pressure point we identified is closest to releasing. Low scores on all 3 indicators equals a market where the lock-in trap is actually providing genuine protection by keeping quality inventory off the market and maintaining scarcity value. The third and final element of the framework is what experienced investors call the optionality preservation strategy. And this is the piece that applies most directly to the prospective buyers who have been waiting on the sideline through this entire frozen market cycle. Stop here because this is the most actionable section of everything we have covered today. The worst financial decision a locked-out buyer can make in the current environment is deploying their entire accumulated capital reserve into a purchase the moment rates move favorably. This is the mistake that compressed demand almost always makes when a frozen market begins to thaw. Years of frustration and anticipation produce an emotional urgency that overrides financial discipline. Buyers who have been waiting for 3 years convince themselves that the first sign of market movement means they must act immediately or miss the window entirely. The historical record does not support that urgency. In every previous cycle where a prolonged period of suppressed transaction volume was followed by a market reopening, the initial phase of that reopening produced neither the best prices nor the best selection. The best entry points came in the second and third wave of the reopening, after the initial surge of pent-up demand had been absorbed and sellers who had been waiting for peak conditions had adjusted their expectations to match actual transaction data rather than the memory of peak cycle valuations. Optionality preservation means keeping a meaningful portion of your capital liquid and uncommitted through the initial reopening phase. It means being financially and psychologically prepared to act in the second wave rather than the first. And it means having done the market category assessment work ahead of time so that when you do act, you are acting in a market where the structural indicators support a durable entry rather than one where the distressed inventory pressure is still building toward its release point. Here is the convergence of everything this breakdown has been building toward. The lock-in trap has created a housing market that looks stable, feels frozen, and is accumulating structural pressure in ways that the headline numbers do not reflect. The 60% of homeowners sitting on sub-4% mortgages are not going to move voluntarily. But the life events that force transactions regardless of rate environments are happening every day. The landlords whose cash flow math has turned negative are making sell decisions right now. The construction pipeline is delivering supply into markets that cannot fully absorb it. And 4 to 5 million qualified buyers are sitting on accumulated capital waiting for a signal that conditions have shifted enough to justify entering. When these forces converge, and the evidence suggests that convergence is closer than most mainstream market commentary is acknowledging, the resulting market will not look like 2008. But it will not look like 2021 either. It will look like something in between. A market of genuine winners and genuine losers, determined not by luck or timing but by the quality of the positioning decisions being made right now, before the convergence becomes visible to everyone. The homeowners who did their liquidity audit. The investors who identified their market category honestly. The buyers who preserved their optionality rather than chasing the first wave of a thawing market. These are the individuals who will look back on the current cycle as the moment their financial position was either protected or built. The lock-in trap is holding the U.S. housing market hostage right now. But hostage situations do not last forever. And the negotiation, when it finally concludes, will not be on equal terms for everyone in the room. The question is simply which side of that negotiation you are positioned to be on.